Okay, ready. Right, hi everyone. My name is Richard Perry. I am the market analyst at Hantech Markets, and this is my latest monthly webinar with FX Street. And this time around, I'm going to be just talking about general market themes, really. Just looking at where the markets are at. Obviously, the big factor of the time is Brexit and the impact that's having across markets. And I'm just going to sort of go through a few slides. Looking at my outlook on the markets and sort of talking about what to look forward to in the next few days. We've obviously got non-farm payrolls on Friday, which will be a potentially a big mover of the markets as well. So lots going on, and it'll be interesting, hopefully, to see what's happening in the markets. But I'm going to share with you my slides now. So I'm hoping that you can now all see my slides. Now, before I get into it, well, the key themes for your trading in the days ahead is what we're calling this presentation. Before I get into it, just a quick disclaimer, because I'm going to be talking about sort of my views and live market information. So you need to have read and understood the disclaimer. And I will show it to you again at the end of the presentation. What I'm going to just go through, as I said, quick agenda is basically the current outlook for Brexit and what that's doing or has done to the markets. What Brexit could be doing in the coming weeks and months as well. Going to then sort of look at the key economic events to watch in the coming days. Obviously, we've got ISM, non-manufacturing Fed minutes today, and non-farms will be the big focus on Friday. What is the general market outlook? Key fundamental macro themes, and then I'm going to be doing a live technical analysis of major forex markets, indices, and commodities. If at any stage you do have any questions for me, I'd be more than happy to sort of look at them. If you've got any instruments that you're trading, please just ask me, and I will sort of give it my all to try and sort of encompass what you're talking about. So, or what you're looking at. I've got the chat room open, and I've signed in. So just put your questions there. Anyone who has any. Right. Now, obviously, we've got the markets that are looking at sort of the post-Brexit world. Really, we've had significant volatility in recent weeks, and that's not really going down too much. I mean, I'll show you a chart of the volatility on sterling options, 1 month sterling options. They're still up at 16, and that is still very high. You can see that the elevated volatility are well above the general election and the Scottish independence referendum, and still at levels that we had around the election of 2010. Obviously, we actually peaked in the volatility above the height of the financial crisis just recently on the Brexit vote. It has been reduced, but it's still incredibly high. And what we've seen in the last sort of day or so is again huge moves on sterling, and that is something that the markets are still looking at. So that is sterling 1 month options. 3 month options again still elevated in terms of the volatility. Interesting that we're seeing volatility also on equity markets. Now here we have sorry, some Chinese yuan. I'll talk about that in a bit. Here we have equity market volatility on S&P 500 options, and what we've seen is the volatility coming sharply down. It's back sort of around levels that you could argue is reasonably complacent. And just looking at the FTSE volatility as well, you can certainly see a negative correlation between FTSE volatility and the FTSE 100 index. And FTSE volatility is still very low, or has fallen away to be very low in the last few days. Now, you could argue, is that a little bit of complacency creeping into the market? Well, I think FTSE is a little bit of a different kettle of fish at the moment, because we're seeing, and I'll talk you through this in a bit, but you're seeing FTSE 100, which is going strongly higher on the back of the weaker sterling. So any sort of sterling weakness, the big selling pressure coming through sterling, that is actually having a positive impact on FTSE 100, because you're seeing FTSE 100, which is around about 70% of FTSE is foreign generated revenue, and that obviously will benefit to quite significantly on the back of the weaker sterling. So that is certainly an impact on FTSE, but other equity markets are perhaps not so positive. Certainly the DAX and the CAC in Europe are not all that well positioned. Other factors, key issues that we're looking at is obviously politics now, the internal UK politics, leadership battles for Conservative and probably Labour as well, not even to mention the UKIP, Nigel Farage quitting as well. You're having political overhaul in UK, and what does that do for markets and confidence for the UK economy and also UK asset classes as well? I mean, certainly sterling is the main factor, is the main dry sort of market that will be under pressure on the back of that, but also potentially sort of seen through UK focused equities as well. Now the UK FTSE 250 is under significant pressure still, despite the fact that the FTSE 100 is trading up around highs, is up around sort of 2016 highs. The 250 is still under a lot of pressure. That's because it's UK focused rather than international focus, which is what the FTSE 100 is. Impact on Scottish independence. What are we looking at in terms of whether the Scottish nationalists will now push for another independence referendum? It's probably likely that highly likely that they will. Whether they would be granted another independence referendum is another point. I think it probably depends on what the polling data suggests. However, would the whole of the UK actually be ripped apart? What's the EU reaction? Well, obviously Jean-Claude Juncker has been fairly steadfast in his opposition to UK generally since the Brexit vote, and he's not letting anyone talk to UK commissioners, and it seems as though that he's also sort of saying that there'll be no preliminary discussions either. So he's being pretty sort of staunchly against the UK, and you could argue rightfully so, but also I think it's in the EU's best interest as well to sort of talk to the UK and get the best out of what looks to be a bit of a ropey situation at the moment. In terms of impact on the economy as well, the impact on UK growth is fairly high. You have sort of the outlook from the IMF suggesting that the impact on the UK economy or GDP could be between -1.5 to -4.5 by 2019. And S&P, the ratings agency, came out the other day and said that the UK would barely escape a fully fledged recession. I think the interesting factor could come through in the PMI data, actually. And you've already seen the construction PMI falling to 46, well below the 50 level, which is into negative territory, into contraction territory. And you could well see a trend of that coming in the next few months, and that would certainly put pressure on UK growth. I mean, a lot of the banks are saying that UK could fall back towards zero growth. I mean, growth in the UK at the moment is running around about sort of 2%. It could easily come back. I mean, the Bank of England thinks that a negative impact of Brexit could be around 3% in the next 18 months. So you could see that 2% growth wiped out for the rest of the year potentially, and negative growth or recession in the latter stages of this year possibly, but more than likely into 2017, I think you'd imagine. What's the impact on the eurozone? Well, how is Brexit going to be impacting the eurozone? Well, presumably negatively, because it's a big trading partner. So negative UK growth would be negative for the eurozone. What impact would that have on ECB monetary policy? 0.5% off GDP is what Mario Draghi was talking about So it could still have quite a sizable impact on the Eurozone and likelihood of pushing further monetary easing, but I'll talk about that in a bit. Rest of the world, I had read that UK could or Brexit could drive down global growth by around about 0.1%, but it doesn't sound a lot, does it? But certainly across the whole context of the world, that probably is quite sizable. So impact on monetary policy. Obviously, we've got central banks are already reacting. Bank of England monetary policy is likely to be looser in the coming months. That's the assessment of Mark Carney. He was suggesting that the negative impact on the UK economy will drive looser monetary policy over the summer months, probably. Now, that I think points towards August, because August being the next time we get an inflation report out from the MPC. Beyond that, it's November, and I think Carney's talking about the summer, so you probably point towards that August month to be the time that to be the next time that we get monetary policy possibly easing. Would that mean further quantitative easing? Well, I was reading today that possibly you could see sort of 0.25% to 0.25% to maybe cut interest rates or further quantitative easing of 100 billion euro, of 100 billion sterling. That is possible, and certainly we'll see how that pans out. But as I said, August is the next time that we could see some monetary easing from the Bank of England, probably because July is too soon. ECB, but Mario Draghi has been talking about competitive devaluations, and that would, I mean, if he's already talking about it, the chances are they're already preparing for it, and the likelihood is that the ECB will want to try it in some sort of way and get ahead of the curve. Probably. I mean, this is all conjecture, I suppose, at this stage, because no one really knows the impact on economies. But I think the chances are that Draghi will not want to see the Eurozone or the ECB lag behind other central banks. I mean, already you're seeing the Chinese People's Bank of China devaluing the yuan. Let me show you. Chart that you saw initially was this chart here. The yuan being massively devalued actually in the last sort of couple of months. That was Brexit day, and we've seen subsequently the yuan consistently, the midpoint of the yuan being extended outwards. So the People's Bank of China is already trying to sort of react to the prospect of weaker economies and weaker growth around the world, and it certainly seems to be preparing for it through its monetary policy at the moment. So what would that mean for the ECB? Well, probably they'll react in some sort of way as well. So I think that would drive a lower or weaker euro. What's going to happen to the Fed monetary policy? Well, already we've seen. Let me just see if I can show you. Fed monetary policy. The expectations had been prior to Brexit that December was going to be a month that the Fed was going to move. This is the CME Group Fed Watch, and it sort of charts the expectations of monetary policy for the States. Now, in December, the chances of a rate hike is actually about 15%. Seems to be. So the market is basically not factoring in a rate hike whatsoever. Now, I think it'll be very interesting to see, because I'll talk about the Fed meeting minutes a little bit later, but we've got the Fed meeting minutes tonight, and obviously the last Fed meeting came out just prior to the Brexit vote. It'll be very interesting to see what the Fed suggests in terms of its reaction to Brexit, because there were sort of mumblings of Brexit running up to in the last sort of meeting, and in her FOMC's press conference last month, Janet Yellen talked about Brexit as well. So there's likely to be fairly sizable reference to Brexit, I think, in the Fed meeting minutes tonight. So the market will be certainly focusing on that. That announcement comes out at 7 o'clock this evening, and quite how they then position themselves. It will be interesting. I think there'll be movement on these Fed minutes tonight, because that will be certainly the main takeaway. Obviously, now we've got a Brexit that's in place. What is the market or what is the Fed going to do next? Well, certainly the market is expecting no interest rate hike this year, and even the February meeting doesn't look likely either. Interesting that we're now even seeing possibility. Even rate cuts, you weren't seeing those previously, but still, it doesn't look like we're going to get a Fed rate hike anytime soon. Now, what does that do to the dollar? Well, I think that the fact is that the market is so concerned with the impact on global growth that the dollar becomes a safe haven trade, and that's attracting investors into the dollar. Now, you've seen, this is the dollar index, trade weighted dollar index. You've seen that was Brexit day, where the dollar strongly moved higher. It's since been sort of drifting lower, but yesterday was another turnaround day on the back of a massive safe haven shift again, a renewed sort of impetus for the safe haven trade. Concerns over global growth again pushing traders into the dollar. So every time you're seeing the market's concerned over Brexit, concerned over the global growth, you're seeing the dollar being bought. Dollar outperforming the major currencies, with one exception, and that being the yen. Yeah, that's a very interesting chart that we've got going there, the dollar index, which on anyone who knows their technicals would argue, is that a bull flag possibility? Pulling higher. If you saw a move above the reaction high at 96.71, which we saw as 2-day high, actually 2 days of resistance up to that level. If you saw a move above that, that would drive gains. I think further gains on the dollar. You could certainly point towards this next resistance of the February high at 98.50 area, 98.60. So yeah, interesting that we're seeing the dollar strength on that. What would happen for the Bank of Japan as well? You've got the Bank of Japan, which is sort of fighting against deflation. Fell into 0.4% in CPI, negative 0.4%, I should say. Last month, you've got the strength of the yen as well. What is the Bank of Japan going to do? Is the market actually banking on the fact that the BOJ can't actually do anything really to make a change, to make a difference? It doesn't really seem as though the market has a massive amount of faith in the BOJ now, seeing as the fact that the yen continues to strengthen, pulling dollar yen ever towards a 100 big figure. But yeah, interesting. And the People's Bank of China, well, I've just shown you that chart of the devaluing yuan, and an attempt to push out China's economic problems onto the rest of the world by devaluing its currency. So when are all these central banks announcing? Well, it's first up, we've got the Bank of England, actually. I think that's going to be too soon for a rate hike. Also, the fact is you haven't got an inflation report either. It's unlikely to really see to really have a preemptive move. It's possible. But I don't think it's likely. I think it's more likely to see a move in August, when we get a little bit of more of an impact. I mean, the markets or the Bank of England will have more information at hand. It will have another set of PMIs that are completely clean. Basically, the August PMIs will have all the will have a whole month's worth of survey data focusing post-Brexit. So what the market will be thinking, it could make a preemptive move. Then that will then be driven through the growth expectations and also inflationary expectations as well. So I think August is more likely for the Bank of England. European Central Bank, 21st of July, a week later. Again, I'm not entirely sure whether they would move before the Bank of England. Again, it is possible, but whether they would or not, I think the Federal Reserve meeting 26th, 27th of July. That is a non-press conference meeting. Obviously, in the light of a Brexit, a rate hike from the Fed is now ruled out, as I showed you on those CME Group Fed Watch, which are the market rates. That's going to be non-existent for a rate hike there. It'll be interesting to see what the differences are in the, the difference is in the Fed statement. I think that month, and how they account for Brexit. Maybe the market will be sort of moving quite strongly on that. The Bank of Japan on 28th, 29th of the month. This is a meeting where they put a load of the BOJ actually does some economic forecasts, and this has been the meeting for even before Brexit. Actually, this was going to be the meeting that the Bank of Japan was probably looking out for to be the mover on monetary policy, because this is as I said, this is a meeting where they do all their forecasts. So it is perfectly possible we're going to get some sort of action. Now, the Bank of Japan, what can they do? Well, it's going to be very difficult, I think, for them to do a shock and awe tactic to stop the yen strengthening. Let me just get a chart. Actually, where am I looking? Is it that? Yes, it's that chart, and I'm going to do that. You can see here. This was when they moved negative interest rates. This candle, this bar here. What was that bar? It was 1850 to 2160. So around about 300 ticks. You add 300 ticks to dollar yen now. That's 103. Does nothing, does it? Would that actually do anything? I mean, the market is basically telling us, I think, on dollar yen that the BOJ is in real trouble. It is really struggling to curb the strength of the yen. What can the Bank of Japan do? It's going to have to come out with something ridiculously big to really stem the tide, I think, of the yen. Yen strength in the wake of Brexit. It's just, I mean, Brexit is pretty much driving everything at the moment. The reaction to Brexit, big safe haven flows. I'll take you through the charts in a bit, but big safe haven flows impacting across markets, and it is a real struggle for the Bank of Japan to really curb the strength of the yen at the moment. Again, we're seeing another move. What's that? 140 ticks with now down on the yen. It's coming back towards 100 parity, 100 big figure. The low is at 99.08. It's likely to be seen, and possibly even lower in front of the BOJ meeting. And other central banks are basically sort of further out into August and September, apart from the Bank of Canada, which is actually first up. So what are we looking at in terms of market moves in reaction to Brexit? Well, I think a continued safe haven shift in markets, and also, as I've been saying for a week or so now, I don't think the true market reaction is yet to be seen in full. And certainly, cable has started to accelerate to the downside. Dollar yen's accelerating again. It'll be. I think the rebound was and subsequent consolidation that we saw last week was just a near-term, just a bit of respite really before further selling pressure, because nothing's changed. Nothing's changed on Brexit. The world still thinks that the UK economy is still in a lot of trouble. I spoke about the political implications, the political turmoil that we've got in the UK. The fact that you're going to see the Bank of England coming out and cutting monetary policy. These are all sort of panic measures, effectively. So what sort of contagion are we going to get from the Brexit fallout is interesting, and no one yet knows. So with the uncertainty still coming through the markets, that's going to be putting pressure to cable to the downside. So investment bank forecasts continue to suggest sterling weakness. Well, I don't really see that that's wrong. Around the time of in the run up to the Brexit, they was talking about 15-20% of downside. That was around when cable was 145. If you take 15 to 20% on cable, that's sort of a bottom of 116 possibly to 123. So there is still huge further downside possibility, I think, on cable. And what's going to perform well in these times? The yen, and to a lesser extent the dollar, but certainly the yen, and to be honest, Swiss franc as well to a certain extent will hold up well, I think. But certainly the yen being the major market that will perform well, or major currency, I should say. What's going to underperform? Well, obviously cable, and I think also the euro. The euro will be a weaker currency as well. I think euro dollar I think is going lower. I think subsequently the euro is under pressure because of the contagion impact of its nearest major trading partner that is under such sort of economic turmoil at the moment. In terms of equity markets, well, FTSE 100, as I said, FTSE 100 is at a high. Where is that chart that I just showed you? Is it that? Yes, it is. Wrong chart. Sorry. Here we go. That chart. Right. So let's look at FTSE. FTSE 100 has broke out to the high since August last year. I mean, you could argue, how is that even possible? Well, that's possible because of, first of all, as I said, 70% of the index generates revenue abroad. So if you translate that back into sterling, having had sterling falling away sort of 12-13% as it is now, you're going to get an uplift in earnings. And also, anyone who pays dividends in dollars is going to be laughing, and that's the likes of the oil majors, and the oil majors are a big weighting. So yeah, that is why the FTSE 100 has rallied hugely, and to be honest, to a certain extent, is holding that rally. You compare that to FTSE mid cap, under huge pressure still. You had the sharp sell-off rebound, but you're getting sold off massively again. So it is under pressure in terms of the UK-centric companies. So there are your winners and your losers in these equity markets. Certainly, your winners being foreign overseas revenue generating, paying their dividends in dollars. Your losers being anyone with focus on the UK eurozone, in terms of economic, in terms of trade. So yeah, anyone in terms of like local focus, house builders, leisure. Anyone who sort of is focused on the UK. DAX is again under pressure. Seeing I'm sort of looking at charts. Let's get a chart of the DAX. I'll do technicals on these in a bit, but I just want to quickly, briefly talk about these. DAX under pressure. Similar sort of outlook, isn't it, to the mid-cap FTSE, FTSE 250, where you had the sharp sell-off, the bounce, and then the sell-off again that looks like it's going to retest the lows. And that is because, again, it's focused on export, and there's serious questions going on now in terms of global growth. So the DAX is under huge pressure due to that. So that is what we're looking at there. So lots of downside pressure on the DAX. In terms of commodities, safe havens, gold and silver, wow, huge upside moves on gold and silver. Again, let's just have a quick. So yeah, so huge upside moves on gold and silver, as gold and silver being seen as a safe haven. Now, the whole factor behind gold is that you've got a continuation of loose monetary policy, negative interest rate, negative real interest rates, I should say. You've got negative yielding treasuries, negative yielding government debt, and this is all sort of ties into what is seen as a desire for gold to be a safe haven, and that is certainly the case at the moment. Let's just show you gold breaking out. Coming up to the highest since March 2014. Silver following it, but accelerating as well. It's yeah, silver is another one. They're both very, very strong at the moment, running higher, and certainly the safe havens are in focus. Now, in terms of the oil price, questions over global growth hit the oil price, because obviously the oil price is seen as a bit of a proxy for global demand. Although obviously it's got supply issues as well, but certainly when global growth is considered to be strong, then the oil price should theoretically push higher. So the recovery that we've seen in recent weeks and months on oil may be questioned, actually, on the back of that, but it'll be interesting to see whether that is the case or not. Very quickly, what we're looking out for in the coming days: continued Brexit trading swings. US to take the focus, because we've got non-farm payrolls on Friday. In front of that, you've got the ISM non-manufacturing. ISM non-manufacturing, which last month was actually lowest since February 2014. It's expected to come in at 53.3, so very slightly higher, but again, that's not really all that positive, is it? So again, that's not really reflective of a positive market. You've got the ADP employment report. Didn't do a great job last month of calling the 38,000 on non-farm payrolls, but still the expectation is around about 165, I think it is, which is around about where the payrolls expectation is this month. Weekly oil inventories tomorrow, actually, because of we had a public holiday on Monday, has been an oil inventory drawdown, if I can say it, in the last, what was that, 6 weeks. It's expected to be another one. Let me just show you. Expected to be another inventory drawdown. Here we go. See FX Street, I'm using your calendar. There you go. Where is it? There we go. Well, it's 4.5. It's actually around about 1% is the expectation there. I'll use my Reuters one instead. No, sorry, 2.5 million barrels is the expectation. So yeah, it seems to be that has a tendency to provide support for the oil price in recent weeks. So watch out for that tomorrow evening. And then we're looking at payrolls report on Friday. As I said, around about 175,000 is the expectation there. What would be considered a solid payrolls report? I would say around about that 175, with unemployment holding, participation rate rising, I think is important. Let's show you the participation rate. It's fallen away for the last couple of months, I think, and that is a problem, because people dropping out of the labour force is not good, and that is the reason why we saw unemployment dropping to 4.7 last month. That is why we saw that. So you need to see, I think, participation rate picking up, and that would be a sign of a positive move on, I think, in the payrolls report. And also the average hourly earnings now on a monthly basis, month-to-month basis, it's pretty much always expected to be 0.2%, or certainly so Reuters, or according to Reuters anyway. Let me just show you. No, sorry, wrong chart. Average hourly earnings expected to tick higher to 2.7. That would be if you did get 0.2% month on month. So that would be continued traction to the upside, and again, that would be a positive move. That would be a good move for the outlook for the labour market, and also inflation as well. So that would be strong for the dollar on Friday. So yeah, that's what we're looking at. Okie dokie. That's me sort of talking a lot about markets or outlook for markets. Now let me look about the technicals. Now here we see one place to start really, and that's sterling dollar. Look at that massive, again another breakdown. 31-year lows we're seeing on sterling dollar to the downside. Yesterday's move initially found support around the big figure level of 30. But again, moved to the downside again today. We've had an intraday rally on cable. Is that actually going to be a rally that is sustainable? Not in my mind. Rallies are a chance to sell on sterling. I just cannot see this stopping at the moment. This is the monthly chart on cable. A massive breakdown, levels not seen since 1985. So I think that I don't really see how we're going to be stopping at the moment, because the momentum behind cable or sterling weakness is just huge. And again, another downside break in the last couple of days. I just don't see what's going to, at the moment, I don't see what's going to stop it. You do have a lot of massive downside targets, and maybe the contrarians would say, well, everyone must be short of cable. So does that now mean that there could be a potential rally? I think theoretically, I think you could argue that, but I think in practice there is nothing positive to really point to. And the fact is that we're going to see the onset of monetary policy further down the road, monetary easing. I think that means that we have still got some bad news for sterling still to come out. I mean, what would happen if, for example, Mark Carney at the Bank of England in a couple of weeks' time said that we're now going to embark upon a series of rate cuts or a series of quantitative easing. I mean, that is new information that the market would take on, and that would drive cable ever lower. So I don't really see how at the moment there could be a bottom, because of the prospect that of further weakness down the line. We don't know how bad it's going to be, and in the uncertainty world, that drives selling pressure. So yeah, I think in terms of sterling downside, you could see much further weakness. In my morning report today, I talked about the fact that I thought that this was a flag breakdown. Let me just do the little drawings of it. And then what you do is you go downside flag. I know it's a bit, and then you sort of measure it from the breakdown. 116.50 area. It's incredible. So it's, yeah, I mean, what are you going to do? I mean, it does look like it's going to be going lower. Although, yes, we have intraday had a rebound, I still think that this is going to be a rebound that gets sold into. So I don't really see how sterling is going to be stopping anytime soon. What about the euro? Well, we had a turnaround on the euro yesterday. Bearish engulfing candle pattern. Breakdown of I love this euro chart at the moment. I really do. I know that sounds geeky, but I really love it. The fact that we've had this uptrend broken, that uptrend then became the basis of resistance. We had this top pattern in October completed. That was that big candle there was the day that Mario Draghi talked about further easing in the ECB. Subsequently, we saw 800 ticks of downside in 6 weeks. What have we got now? Well, we've had a similar looking uptrend channel, and we've got a similar looking downside break. And the chances are, with Mario Draghi talking about the prospect of competitive devaluation, chances are we're going to see further monetary easing from the ECB. At the moment, we've seen from that top at around 114.30. We've only seen sort of 350 ticks of downside. Last time we saw monetary easing from the talk about monetary easing from the ECB, we lost 800 ticks. So does this mean we're going to see further downside move? I think this is a top pattern again, similar-ish to this one here. That we've got this top pattern in place. Again, the neckline at 111 figure. Top neckline breaking down. And that even if you measured sort of 14 down to 11 figure, that's 300 ticks measured down from 11 figure. That's 108. 108 is a big long-term floor on euro dollar. So I think that there is the prospect of further weakness in euro dollar, and having broken this uptrend, that now becomes the basis of resistance, as it did yesterday. Big bearish engulfing pattern. Momentum indicators negative. Negative on euro. I think it's going lower. Rallies are a chance to sell, in my opinion, on the euro. I think that there is further downside that we are going to see. Japanese yen. Downtrend channel. Just looks bad, doesn't it? Lower highs, lower lows, falling over at resistance levels. The latest one around that 103.60 area provided the basis of resistance. As I said, this rally that we saw in January, that was on the move to negative interest rates. 300 ticks, 340 ticks or 320 ticks or so. Again, what would 320 ticks do for euro dollar, for dollar yen? You'd be back at this breakdown level. Nothing. It would do absolutely nothing. The rally we saw in May to June, 105.50 up to 111, 500 ticks, 550 ticks. 550 ticks is obviously 105.50, 105.80. Again, this breakdown level here. I've sort of said on my morning report that I see a sell zone on dollar yen. This sort of blue box here. Resistance band 103.60 to 106.80. 106.80 being the Brexit day high. So I think that's an ideal resistance band. If you saw a BOJ induced rally, I think that's a selling opportunity. But in light of what we're seeing at the moment, again, 140 ticks down on the day, it looks like we're going to test 100 figure. It looks like 99.09 is going to be where we're going to be coming back to, and possibly even lower. What should I do? Aussie dollar. Aussie and Kiwi look similar again. Little top pattern, possibly top pattern. Strong downside candle. Actually, I mean, I did this in my morning report today because I thought this was going to start to go lower. It's actually held up today. It's actually held up. But I think dollar strength is what we're going to see generally, and that's going to pull Aussie dollar lower. You got this stochastics, which I think is the concern. You've turned lower around about that level, that old level. Also at 60, turning lower. MACD line sort of running out of steam as well. I think this is going to turn into certainly a move back below 74, maybe 73.85, maybe 73 figure being the sort of neckline support. You look at Kiwi, very similar actually, but a bit higher. Similar sort of top pattern possibly developing. Kiwi is weaker than the Aussie. Again, same pattern that we've got on the stochastics. Rolling over again. Same issue on the MACD lines, flattening off. Same issue on the RSI as well, although it did get to 65, but certainly turning lower again. So both very similar outlooks really against the dollar, although the Kiwi is slightly stronger, although it's not performing as well as the Aussie is today. But I think that it's going to sort of, both of them are going to pull back to these neckline support areas here. And it'll be interesting to see what happens then. Okay, let's look at gold. I sort of spoke about gold being a breakout level, strong move, 1370. I mean, the next level up to the upside is that 1391 high from March 2014. You look at the RSI, strong momentum, 73, highest since Feb. In Feb, it got to 86 on a strong run higher. I think you can certainly say we're on a strong run higher now. I would say that this has got upside potential in it. MACD line strong, stochastic strong, pretty much across the board, all good. And I think that further gains are going to be seen on this chart. It looks pretty strong. That's annoying. Please respond, because I'd like to change the chart. No? Okay, fine. But yes, gold generally. I think on a medium-term basis, medium to longer term basis, I would say 1306 is ideal for a buying opportunity. It's that breakout level. It's that lovely long-term breakout level. if you saw a medium term or near to medium term correction, just unwinding some of this move, I think around 13 big figure would be ideal for longer term bullish trades, because that's such a strong support now, having been already tested. I mean, arguably you've already had the pullback, which found support bang on that level and then pulled higher. And maybe it's already gone away from that level, but I think on a longer term basis, 13 big figure area is ideal on gold. Similar sort of situation on silver, really, but gold on steroids is what I called it in the morning report today. It is certainly true. Silver 2% higher on the day, gold around about 1%. It seems to be that silver is the leveraged play effectively on gold. Still very strong. RSI 79.80, very strong momentum. Stochastics having rolled lower. You had that corrective candle yesterday that, to be honest, has been undone by today's move. There is the prospect of further upside. Next levels overhead, big levels, 2150 from that July 2014 high, and 2216. Now it's interesting because 2216 is the February high for 2014. Now you could argue the equivalent high on gold is $1,391. So gold in that regard is more sort of developed in terms of its bull run, but obviously silver had more of a downside move obviously than gold, and it is catching up quickly. And I'm tight for time, so I'll just very quickly look at DAX. Yeah, it's rolled over again. Sort of basis. I mean, I've looked at the fib levels frequently on the DAX because I think they provide very strong turning points. We're back at the fib level now for 93 area of 76.4, which has provided the space of support previously on numerous occasions, although obviously in February it didn't. Below 93 figure, you're looking at the support 91.25, and obviously that massive low 8,700. But at the moment, the DAX is under real pressure, and it's taking a beating on the fact that you've got sterling weakness and also the concerns over global growth. So the DAX is under real pressure. Gaps all over the place, as per usual on the DAX. Doing gap analysis with the DAX doesn't often help, but certainly that's what we're seeing. We've seen very strong downside move on the DAX. And finally, FTSE technicals breakout above 5427 has sort of strong move to the upside, yet to actually sort of pull back to that level. So maybe that's what we're seeing now. But technicals on the FTSE are so much more strong, aren't they, than the DAX? It's incredible. The move that we saw in the FTSE just left the DAX and the CAC utterly in its wake, and really strong downside moves on the DAX and the CAC, but not reflected in the FTSE. So breakout above 6427, that is obviously a key basis of support now on this correction. Downside move today, 65 ticks down as a percent. 1% down on the day, but 64.27 key breakout support. Strong momentum, although you could argue it's basically not a million miles off ranging, but the breakout above that resistance sort of looks to try and improve the outlook, and it'll be very interesting to see what happens with FTSE if the UK economy continues to deteriorate. But weaker cable or weaker sterling is certainly a supportive aspect for FTSE. So that's 11:50. So I know FX Street like me to sort of wrap up. So what I will do is I will wrap up now. You can go on to our website, handtechfx.com /category/research, and check out my research. It's all free, so you can get it there. You can sign up. You can sign up to get the research delivered to your inbox as well. Follow me on Twitter at HandTechRich. We've also got a forex traders LinkedIn group called Forex Traders Talk, and I'll be joining you again next month for another webinar. But with that in mind, I wish you good luck. Here's the disclaimer again for anyone who didn't get a chance to read it earlier. But good luck in all your trading, and I will speak to you again soon. Thank you very much.